Part 1. The seduction of timing. Timing the market feels logical. We see charts going up and down, and we think, if I can just predict these moves, I'll make a fortune. But the stock market isn't predictable like the weather. Imagine trying to catch the exact moment a wave breaks on the beach. It looks easy, but the ocean has its own rhythm. The market is the same, full of surprises, driven by millions of decisions, news, and global events. Investors who try to time the market often end up doing the opposite of what they planned. They sell when fear is high and buy when greed is high. Part 2. The cost of missing the best days. Here's the shocking part. Studies show that if you miss just a handful of the market's best performing days, your returns collapse. According to JP Morgan's analysis of the S&P 500 over a 20-year period, if you stayed fully invested, your annual return was around 7%. But if you missed only the 10 best days, your return dropped to just 3.5%. Missed 20 of the best days, your return was basically zero. Think about that. 20 days out of 20 years. That's less than 0.3% of all trading days, making the difference between solid growth and nothing. And here's the twist. Those best days usually come right after the worst days, when most people are too scared to invest. Part 3. Real life example. 2008 crash. Take the financial crisis in 2008. The market dropped nearly 50%. Many investors sold out of fear, but in March 2009, the recovery began, and the S&P 500 rose more than 60% over the next year. The people who tried to time the bottom often missed that explosive rebound. The same pattern happened in March 2020 during the pandemic crash. The market collapsed, then quickly rebounded with some of the strongest daily gains in history. Miss those days, and your portfolio's long-term performance is destroyed. Part 4. Why it fails. So why does market timing fail? It's unpredictable. No one consistently calls tops and bottoms. Emotions interfere. Fear makes us sell too early. Greed makes us hold too long. The math doesn't work. Missing just a few strong days ruins your compounding. The truth is, even professional investors and hedge funds rarely beat the market long term. If they can't time it, why should we think we can? Part 5. What works instead? If timing fails, what's the alternative? Stay invested. History shows long-term investing in broad indexes like the S&P 500 delivers strong returns. Dollar cost averaging. Invest a fixed amount regularly, no matter what the market is doing. This removes emotion and ensures you buy both highs and lows. Focus on time in the market, not timing the market. Remember, wealth is built by compounding over years, not by guessing short-term moves. So the idea of timing the market sounds perfect, but in reality, it almost always backfires. Focus on staying invested and let time do the work. Thanks for watching, and I'll see you in the next video.